Hello and welcome to another Smaulgld live stream. Today is August 16th, 2019, and today's topic: inverted yield curve is the new Schmita. Back in December 2018, the financial media, mostly the alternative financial media, was having a field day with the yield curve inverting, and therefore it was game over and we were going to see a recession because there is a concept that over the last 60 years when the yield curve inverts, you have a recession within 6 to 24 months. Now, I actually place very little stock in this particular indicator. Why? Because first of all, 6 to 24 months is a long time. In the normal business cycle, there's always a recession around the corner. It's only that in the last 8 to 10 years, due to massive central bank intervention, that we don't have a recession every 3, 4, 5 years or so. So to say that you get a recession every 6 to 24 months when the yield curve inverts, that to me is not a good indicator. Furthermore, I do agree that the concept of the yield curve inverting does mean that investors are uncertain about the future. Well, to that point, investors are always uncertain about the future because no one knows the future. Now, I did a video on this, and I'll leave the link on the Smaulgld website on the link below this BitChute and this YouTube, going into more detail on how bonds work and what an inverted yield curve means. Briefly, an inverted yield curve means that the shorter dated bonds have a higher interest rate than the longer dated ones, which generally wouldn't make sense. You get a higher rate of interest generally the longer you put your money at risk. What happens in an inverted yield curve is the shorter dated ones may actually pay a little bit more based on the pricing of the bonds, not by the issuer initially, but what happens in the aftermarket. People will bid up the shorter term bonds. They figure, look, I don't want to get into a longer term bond. I'm going to buy the short one. And what that does is it drives the price of the bond up, which means you pay more than the par value, which means that the original coupon on that bond will actually yield a bit less than the original. Okay, so when that happens, when the yield curve inverts, people are out there screaming and yelling there's going to be a recession because it reflects uncertainty, and that's a harbinger for a recession. If you have a lack of confidence, you have which is what you get from uncertainty. Well, clearly that means the bond market knows. This is a sign without anyone telling you this. This is the market telling the world that there's a recession imminent. Now, I do think that some things are different in this case. Clearly, they are different. Now, a lot of people who are in the alternative financial media, and even in the media, the financial media, they like to say, oh yeah, it's different this time. It's almost a cliche to the point where it becomes, it's factual to say that in a sarcastic manner, that things can never be different. Because once they've established their narrative and you try to point out that something might be different, they give you the old, yeah, it's always different this time. Yes, well, things sometimes are different. And I'll give you an example here. Right now, I'll agree that there is uncertainty in the market. I'll even agree that there is more uncertainty in the market perhaps than there has been. But what is that uncertainty about? What did I just say? Uncertainty in the market. Of course there's uncertainty in the market because you have this massive government intervention. You've got $17 trillion and increasing in negative yielding debt. That is strange and hard for the markets to understand. How's this all going to play out with all this negative yielding debt? But what I'm going to show you is there's a difference between uncertainty in the market and uncertainty in the economy. Now, we've all pointed out, many have pointed out in the alternative financial media, that there is a difference between the economy and the market. That when Trump says the market's doing well, his naysayers say, but the economy isn't doing well. There's many people who have pointed out that there's a disconnect between the economy and the market. I'm going to make that point right now. When traders are uncertain in their bond buying, they're uncertain about the direction of the market, not necessarily the economy. But this is not stopping people from trotting out the old, this is never happened before, it's a game changer, prepare for what's coming. Well, if you remember back in December 2018, this is the video that I did that has all that technical information about the bond market. What did I say? Warning, head to the bunkers, the yield curve inverted. This is just a retread. People, they just parrot this stuff. You say, well, these are smart people. Maybe they're smart, maybe they're not, doesn't matter. One thing is for sure, they are parroting a narrative. Once the narrative comes out, now the mainstream media is parroting this narrative. Well, why do you think the mainstream media is parroting a recession is imminent coming? Well, they want to get rid of Donald Trump. Bill Maher has said that if we can have a recession, we can get rid of Trump. So, of course, they're going to cotton on to this idea. And now, of course, the alternative financial media, we see all types of stories, videos, YouTubes, on Twitter. I've never seen this. I'm so nervous. What's going on? This is unprecedented. Now, remember, what's happening in interest rates. They're very concerned about negative interest rates. I'm concerned about negative interest rates. We've done a couple of YouTubes the last couple of days on how to handle where to put money in a negatively yielding market environment. But negative interest rates are actually, as Bernie Sanders said, that's a good thing. Now, why do I say that's a good thing? Well, let's step back. What did all the alternative financial media people always talk about? The problem with the debt. Oh, at some point, the debt is so great that the interest payments on the debt will be so great that we won't be able to service the debt. Okay. Well, what happens in negative interest rates? There are no interest payments. You pay the borrower. The person who takes out the bond owes the person lending the money. That makes no sense whatsoever. But what does it have the effect of doing? Well, it has the effect that whoever the issuer is, they don't have to worry about servicing the debt anymore. Why? It gets serviced to them rather than them having to service the debt. That's a very important point. Yes, it's messed up. I don't disagree. But remember, the biggest game changer was they were going to have so much debt and they wouldn't be able to pay back the interest on the debt. Well, now, as the new debt comes in and rolls over, they don't have to worry about that. Now, no one's talking about that. Of course not, because they focus on the one part that they want to be negative. Now that the one thing they were screaming about, too much debt, never be able to service the debt, at some point, well, that's been changed. I'm not saying that any of this makes economic sense or that one should be jumping up and down and say this is a good thing. But remember, all markets will somehow self-correct, or the interveners, the central banks will intervene to try to make this correct. I'm not saying that this isn't a mess. Of course it's a mess. But the idea that somehow the debt is unsustainable, not when it's negative interest rate, it's not. Now it puts the burden on the investor to figure out, what are we going to do? What are we going to buy? Are we going to go for the safety in the short-term bonds? Are we going to go for the safety in the negative yielding short-term bonds, or the even more negative yielding longer-term bonds? Or are we going to buy alternative assets? Are we going to buy stocks? Are we going to put our money in the mattress? What are we going to do? So this is all part of the uncertainty. Now, let's talk about the difference between the economy and the markets. And again, you get this type of sarcasm, this type of, you see, here's what, this is as if the yield curve going negative and already being bearish, that this means there is a recession on the way. Now remember, they thought this back in December 2018, and we had first quarter growth 3.2%, second quarter growth 2.1%, and what do we have now? A GDP projection for the third quarter. Well, Atlanta Fed, which has been pretty accurate, they're thinking that this quarter we're going to be at about 2.3, 2.4%. No recession. But that's not stopping the people from jumping on the bandwagon. I believe in part. A lot of this is, there's tons of people who believe it because they've been told. And sounds smart. And all of the respected analysts that have subscription services and have YouTube channels that have a lot of subscribers, they think, well, they know what they're talking about. Makes a lot of sense. But I also think a lot of it has to do with, this is just an old standby, just like COMEX default, gold back yuan, game changer this, Schmita that, dollar collapse. I mean, you just trot these things out, and this one's good enough that even the mainstream media will repeat. But here's an interesting one. This particular comment actually highlights the idea that, well, you can't say things are different and actually things are. Let's talk about the economy versus the markets. Now, the U.S. economy is, by most objective measures, doing okay. And it's doing okay by most objectives because the U.S. consumer and because the economy, for better or for worse, the United States economy is 70% consumer driven. That's just how it is. It's not driven by manufacturing production. It is in part, but it's mostly how much people spend. And they're spending. Okay, so you say the economy's pretty good. And you've got the tariff threat out there, but that's being offset by the Chinese themselves by devaluing the yuan. And we have seen decent retail numbers coming out. Aha! But the people that are permanently concerned about, not permanently, I'm just saying the people that are buying into the idea that this is not necessarily a good sign because, after all, back in 2007, just before the financial crisis, just before the Titanic went down, people were singing and dancing and the band played on, and that the consumer is oblivious to all this and they just don't know what's coming. But hey, we know. We saw the inverted yield curve. We've been following all these alternative financial media people, and they are insisting a recession is coming, and their viewership is up and their subscriptions are up because they are smart. So, and this person here is actually very smart. I've seen her on CNBC. It's worth a follow. SPOMBOY. Now, she's talking about a big factor today's upside retail sales surprise was department stores. The group posted its strongest July gain since, she says, drumroll please, 2007. Just something to keep in mind amid all the strong consumer palaver. Now, the idea is here that, yeah, okay, the consumer's doing well, but look, when else the consumer was doing well? And the inference there is just before the collapse, you see? Not that things were doing well. Now, my rejoinder to this is, in July of 2007, because now we have the benefit of hindsight of what was going on in July of 2007, the idea that the markets collapsed in 2008, we know why it happened, so it doesn't take any genius to reconstruct what happened. What was happening in July of 2007 was we had a few years worth of massive real estate buildup. People buying houses, liar loans, ninja loans, things that they shouldn't have been doing. You had massive amounts of bad debt, and it was all exacerbated by then them putting them into collateralized debt obligations, doing all types of derivatives, and on the basis that if you just bundle all these bad debts together, somehow you wash out the problem. It's kind of the Michael Milken thing, that high yield bonds will do better on average even with the defaults, because sure, if you buy 1,000 bonds of high yield, some of them will default, but overall most of them will pay, and you're better off buying a basket of high yield even though there's risk than you are buying just a basket of more safer bonds. It was the same idea with the real estate. Real estate prices are never going to go down. Even if they do, the model said they go down a little bit, just a little bit, and there won't be a problem because, yeah, some will default, but they won't all default. Well, wrong goes star. A lot of them default, and that set off what you call the daisy chain. You had all the collapses. Now, the consumer was spending a lot of money back then. And think about where they got their money. They were getting money out of their houses. They were doing home equity loans. Of course they were spending money in July of 2017. And look later what happened when their home equity went down. And down went the July sales data. Also, during that time, the 30-year mortgage, what was happening, and maybe no one was paying attention, but it's pretty obvious now, mortgage rates were rising in 2007. That was putting pressure on all those subprime mortgages prior to the financial crisis. Okay, so now here's what's different between July 2007 and July 2019. And I'm not saying that in next year at this time there can't be a recession, there won't be a collapse, but maybe it's not because of this particular dynamic. Okay, so in July of 2019, we have the exact opposite situation. First of all, we have a much smaller pool of low-quality subprime mortgages because the banks didn't loan that way anymore. They haven't been loaning that way since 2007, 2008. But the 30-year mortgage is falling from 4.45 to 3.6%. The unemployment is lower. So the U.S. economy is better today than it was in 2007, at least in retrospect, and at least in what we know now, unless there's some hidden data behind the current numbers that we're unaware of. So I don't believe that this chart shows that the consumer is dumb, doesn't understand what's going on. They don't understand the inverted yield curve. They're not subscribing to this newsletter. They're not watching these YouTubes. They're not as smart because people are just looking at this retail sales data and saying, everything's fine, nothing to see here. Well, because if you go back to 2007, they thought everything was fine then. Well, maybe everything wasn't fine then, but maybe everything is fine now, at least from the standpoint of the economy. But no, you can't, but it's different this time. Is that what you're telling me? Yeah, maybe. See, that's where once you get boxed in to thinking a certain way that there has to be a recession and you're going to explain away the July retail sales number by pointing to, well, there was a collapse after we had good July retail sales numbers in 2007. I think there's a switch that goes off and you figure all you're looking to do now is support the narrative that there must be a recession coming up. And again, go back and listen to, I'll leave the link below. I had Head for the Hills, the yield curve inverted. Everyone was jumping up and down back in December. The article is also entitled on Smaulgld.com, Does an inverted yield curve mean a recession is coming? I say maybe, maybe not. And I also say maybe it has nothing to do with anything. Maybe the inverted yield curve reflects market uncertainty and not necessarily economic uncertainty. And just put that tweet out today. Perhaps an inverted yield curve represents uncertainty about the markets, which clearly we've had a volatile market. We've been bouncing along at the top of the Dow Jones, the S&P, NASDAQ for 18 months now. But a recession is an economic indicator. It's not a market indicator. So the fact that the yield curve, in my opinion, is probably reacting to markets uncertainty, markets causing market volatility, doesn't mean there's going to be a recession. There's one final point on why I think there's not necessarily going to be a recession is the United States is indeed in a different circumstance. And it goes back to what I've been saying and following the markets, well, I guess since 2013 and 14, when I was saying the Fed had to raise rates, would raise rates, when you had all the commentators saying the Fed could never raise rates. I said the reason they're going to raise rates is they have to raise rates because they had to put some distance between themselves and the other central banks if they wanted to maintain the dollar hegemony or the hegemony and continue to be the world's reserve currency. So what did the United States do, or the Fed did? They canceled QE. They stopped QE after doing about $4.5 trillion. Then they talked about tightening. They talked about raising interest rates, but they didn't do it for a while. But meanwhile, immediately when the United States, when the Fed stopped QE, what did Japan do? They engaged in a massive more QE themselves. Stanley Fischer, the vice chair of the Fed at the time, went over to Mario Draghi and convinced him to do QE, which they had never done before. Right now, ECB is well over $5.5 trillion in QE, which is larger than the Fed's ever was. They're at negative rates, which the U.S. never was, and doesn't seem like they're going to let up. Doesn't seem like Japan is going to let up. Right now, China is putting massive amounts of liquidity into its system. China, as you know, from my opinion, is a debt-based Ponzi scheme greater than anything else that we've ever seen on the planet. But meanwhile, back in Los Estados Unidos, we have positive interest rates, and for that reason, there are capital flows coming into the United States. So, it's possible. We'll continue to have market volatility. We'll continue to have rising gold, rising silver, and rising dollar prices, and perhaps even rising stock prices, even if interest rates go lower, even if the yield curve inverts. But it doesn't necessarily mean that all of this dynamic means that a recession is imminent. However, we could have a recession. We probably will have a recession. Why? Because we always have recessions. But it's not because, in my opinion, this excessive hype over the inverted Yield curve. Let me know what you think.